In this lecture, we will study integrated CFO decision-making and responsible capital allocation under constraints. The central question is simple to ask, but difficult to answer. How should a financial manager create value when financial, strategic, ethical, stakeholder, and reputational considerations interact? Traditional finance gives us essential tools. We estimate cash flows, assess risk, compare alternatives, and determine whether an investment is expected to create value. But the technically correct spreadsheet answer may still be incomplete. A project may look attractive while creating legal exposure, financing pressure, employee disruption, environmental obligations, reputational damage, or strategic lock-in. Another project may show less immediate financial value, but preserve flexibility, strengthen trust, reduce downside risk, and improve long-run resilience. Responsible capital allocation does not reject shareholder value. It asks whether value is durable, defensible, and created within acceptable boundaries. Throughout this lecture, think of the CFO not only as a valuation expert, but as an integrated decision maker. The CFO must connect financial analysis with risk, strategy, governance, stakeholder impact, and communication. Our goal is to understand how to make decisions that create value and can withstand serious scrutiny. The CFO is often described as the company's senior financial executive. That description is correct, but incomplete. A modern CFO performs several connected roles. First, the CFO is a capital allocator. Scarce funds must be directed toward projects, assets, acquisitions, technology, working capital, debt reduction, distributions, employee capabilities, risk controls, and other competing uses. Second, the CFO is a risk manager. The question is not only what return is expected, but what could prevent the expected cash flows from occurring. Third, the CFO is a steward. Liquidity, reporting quality, internal controls, compliance, and the ability to meet obligations must be protected. Fourth, the CFO is a strategic partner. Financial analysis should support the firm's competitive position, operating capabilities, and long-run direction. Fifth, the CFO is a communicator. Boards, investors, lenders, employees, and other stakeholders need a clear explanation of assumptions, risks, trade-offs, and recommendations. Finally, the CFO is a governance participant. Major decisions require appropriate authority, independent challenge, documentation, and accountability. These roles cannot be separated in important decisions. A project can offer growth but create fragility. It can benefit shareholders while shifting risk to creditors, employees, customers, or communities. The CFO's real responsibility is integration, bringing the full decision into view before capital is committed. Capital allocation is the process of deciding where the firm's financial resources should be deployed. The basic finance test remains essential. Does the investment create value after considering the timing and risk of expected cash flows, the required investment, and the opportunity cost of capital? Net present value provides discipline. Without it, managers may approve projects because of optimism, politics, sunk costs, executive preference, or vague claims about strategy. But net present value is only as complete as the information included in the model. Cash flows may omit transition costs, compliance spending, remediation, labor disruption, customer response, or financing effects. Risk may be mispriced. A project may violate a liquidity limit, a debt covenant, a legal requirement, or an ethical boundary. It may transfer substantial costs to stakeholders. It may also lock the firm into a technology, supplier, market, or operating footprint that reduces future flexibility. The proper response is usually not to abandon valuation. It is to improve the valuation and interpret it within clear boundaries. Some considerations can be priced. They can be reflected through expected cash flows, scenarios, risk adjustments, or option value. Other constraints are non-negotiable. Truthful disclosure, legal compliance, safety standards, and fiduciary duties are not minor sensitivities. A positive valuation creates a strong reason to investigate a project. It does not create an automatic right to approve it. A constraint is a condition that limits the set of acceptable decisions. Some constraints are formal and measurable. Others require professional judgment. In both cases, they should be identified early, not added after management has already become committed to a preferred answer. Financial constraints include liquidity minimums, leverage limits, covenant requirements, credit rating objectives, working capital needs, and financing capacity. Strategic constraints involve brand position, customer promises, core capabilities, technology direction, supply chain resilience, and the need to preserve competitive flexibility. Legal and regulatory constraints include permits, labor rules, environmental standards, tax requirements, disclosure obligations, antitrust review, and safety requirements. Ethical constraints concern truthful reporting, fair dealing, conflicts of interest, contractual promises, and fiduciary responsibility. Stakeholder constraints arise when employees, customers, suppliers, creditors, communities, or the environment bear material costs or risks. Reputational constraints involve trust, credibility, employee morale, investor confidence, and the firm's social permission to operate. Governance constraints determine who must review and approve the decision, how assumptions are challenged, and how conflicts are handled. When a constraint binds, integrated value changes. Begin with the base valuation. Recognize any flexibility created. Then account for mitigation, unpriced risk, and the shadow cost of scarce liquidity, capacity, management attention, or political capital. Constraints should be specific. Saying reputation matters is too vague. A useful analysis explains how reputational damage could affect revenue, costs, financing, regulation, or long-run value. A practical CFO decision process begins with 4 foundational steps. First, define the decision and the alternatives. The analysis should not compare only approval with rejection of management's favored proposal. Real alternatives may include delaying, staging, redesigning, partnering, outsourcing, selling, hedging, or investing in safeguards. Second, estimate financial value. Identify incremental cash flows, timing, taxes, working capital needs, terminal effects, financing implications, and opportunity costs. Keep accounting earnings separate from cash flow, because a project can improve reported earnings without strengthening economic value. Third, identify material risks and constraints. Ask which uncertainties could change the recommendation and which conditions define the boundary of acceptable action. A risk is something that may affect the outcome. A binding constraint is something that limits what the firm may responsibly do. Fourth, evaluate stakeholder impacts. Identify who receives the benefits, who bears the costs, who carries downside risk, and who has limited ability to protect or diversify themselves. Stakeholder analysis does not replace valuation. It improves valuation by revealing obligations, risk transfers, implementation problems, and future cash flow effects that a narrow model may miss. At this stage, the CFO should also ask whether the information is balanced. Are inconvenient facts included? Are assumptions supported? Are realistic alternatives receiving equal attention? A strong process begins by framing the right decision, not by polishing the preferred answer. The next 4 steps turn analysis into an actionable recommendation. Fifth, incorporate mitigation and redesign. Difficult choices are often presented too narrowly as approve or reject. A project may become acceptable through stronger controls, transition support, insurance, reserves, warranties, environmental safeguards, better disclosure, or staged investment. Sixth, test scenarios and downside cases. The CFO should ask whether the recommendation survives adverse conditions. A project that works only under optimistic assumptions is fragile, even when the base case appears attractive. Seventh, clarify decision rights and governance review. Who has authority? Which committee or board members should review the proposal? What conflicts, assumptions, and downside cases must be documented? Eighth, communicate the recommendation. A credible recommendation explains the value, risks, constraints, mitigation, accountability, and conditions that would cause management to reconsider. A concise decision screen can support this process. The value screen asks whether the choice creates risk-adjusted value relative to alternatives. The liquidity screen tests funding capacity and covenant flexibility. The risk screen asks whether downside exposure is understood and accepted by the right people. The ethics and compliance screen tests legality and honest representation. The stakeholder screen examines material impacts and mitigation. The strategic screen tests long-run position and flexibility. The governance screen confirms proper review and approval. The screen does not produce a mechanical answer. It prevents one attractive number from hiding the trade-offs behind it. Scenario analysis is useful when financial value and stakeholder impact move together. A scenario is not one variable changed in isolation. It is a coherent picture of how demand, costs, delays, employee response, customer behavior, regulation, financing, and reputation may develop together. A useful set includes a base case, a downside case, a severe but plausible case, an upside case, and a mitigation case. Precise probabilities may be unavailable, but scenarios still reveal breakpoints and conditions that change the recommendation. The mitigation case matters greatly. Responsible decision-making asks not only what could go wrong, but what management can do now to reduce the likelihood or severity of harm. Non-financial risk is financially relevant whenever it affects cash flows, access to capital, flexibility, or the ability to operate. Model estimable costs directly in cash flows. Use scenarios when risks interact or create nonlinear outcomes. Adjust the required return only for risks capital providers price. Use real options thinking only when management has genuine flexibility to delay, stage, switch, or abandon. Treat legal, ethical, safety, and governance boundaries as constraints. Two cautions matter. First, avoid counting the same risk in both cash flows and the required return. Second, do not use a higher required return as a vague penalty for every uncertainty. Show where the risk comes from and how it affects the decision. Stakeholder analysis focuses on parties that can affect or be affected by the firm's decisions. The purpose is not to create an endless list. The purpose is to identify material effects that influence value, obligations, risk, trust, or the firm's ability to execute its strategy. A useful stakeholder map asks 6 questions. Who benefits, and how reliable are those benefits? Who bears costs, and are those costs temporary, permanent, or uncertain? Who carries the downside if the assumptions fail? Who has information, legal rights, bargaining power, or a meaningful voice? What mitigation could reduce harm without destroying the economic logic of the decision? Who needs to receive information, when, and at what level of detail? When financial value and stakeholder impact conflict, the CFO should ask 4 further questions. Is the measured financial value complete? Is the harm a cost that can be priced and mitigated, or is it a legal, ethical, safety, or fiduciary boundary? Can the decision be redesigned through different timing, stronger controls, consultation, transition support, or staged implementation? And who has the authority to make the final judgment? Financial value creates a presumption in favor of a project, not an automatic approval. That presumption becomes stronger when value is robust, risks are transparent, and stakeholder effects are justified and mitigated. It becomes weaker when value depends on hidden costs, poor disclosure, or fragile assumptions. Governance places major decisions inside a structure of authority, challenge, documentation, and accountability. Decision rights should match the size, visibility, reversibility, and risk of the commitment. Routine spending may be approved within operating limits. Major commitments may require executive, investment, audit, risk, legal, disclosure, or full board review. The CFO's task is not merely to obtain a signature. The right decision makers must understand the assumptions, alternatives, downside cases, conflicts, stakeholder effects, and conditions for success. Communication is also part of the economic decision. A strong recommendation explains the action requested, alternatives considered, financial analysis, strategic rationale, major risks, stakeholder effects, governance process, implementation milestones, and escalation triggers. Poor communication can reduce trust, increase resistance, and destroy value. Transparency does not require revealing every confidential detail, but it does require avoiding misleading or selectively optimistic claims. When uncertainty cannot be resolved, managerial flexibility becomes valuable. The firm may delay, invest in stages, run a pilot, negotiate exit rights, maintain supplier alternatives, purchase insurance, hedge exposures, design reusable assets, or establish decision gates. Responsibility continues after approval. Management should monitor spending, timing, operating performance, forecast accuracy, liquidity, covenant headroom, material stakeholder indicators, mitigation commitments, and emerging downside conditions. Post-completion review turns accountability into learning. Firms improve when they compare forecasts with outcomes and correct repeated errors. Let's bring the framework together with a qualitative example. Imagine a manufacturer deciding whether to close and outsource an aging facility, modernize it, or relocate production. A narrow valuation may favor the option with the greatest expected savings. Integrated analysis asks more. Outsourcing may create supplier dependence, quality risk, and community disruption. Relocation may offer strong upside, but expose the firm to transition problems, training needs, regulatory uncertainty, customer disruption, and reputational damage. Modernization may appear less attractive at first, yet reduce safety and environmental risk, preserve skilled employees, and create future flexibility. After a full review, the ranking can change. The responsible recommendation may favor modernization, stage commitment, clear performance gates, board reporting, and a backup operating option. The lesson is not that modernization is always best. The lesson is that the highest base case value is not automatically the strongest decision. A CFO should slow down when analysis depends on one optimistic assumption, omits transition or compliance costs, favors short-term earnings over resilience, dismisses stakeholder effects as non-financial, provides no meaningful alternatives or downside cases, excludes opposing views, or rushes approval. Responsible finance is not softer finance. It is more complete finance. It seeks value that is credible, resilient, transparent, and accountable. Thank you for joining me today. I will see you in the next video.